I have 5 criteria of businesses that I look at. So the first will be revenue, over $1 million, how many employees they have, preferably 10 or more, their profit margin. So usually I like to see at least on 25% of the profit margin. What's number 4? The age of the business. So 10 years or older. And the 5th one is that it has a manager or operator in place.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor!
Now, here's your host, Dr. Alex Schlow.
Hello, everyone. Welcome back to another episode of the Physicians and Properties Podcast. Today's guest is a returning favorite. Dr. Chiagozie Fawole is a pediatric anesthesiologist, entrepreneur, real estate investor. She's also an author of the short-term rental blueprint, STR Blueprint, and now she's made an exciting pivot into business acquisition. Most people think that physicians only have one path to wealth, and that is medicine, or maybe some index funds, or maybe some real estate. But what if buying an already profitable business could accelerate everything? And so that's what we're going to dive deep into on the podcast today. Chiagozie, so good to see you again. Thank you for coming on the podcast.
Thanks for having me back.
Absolutely. Well, as I mentioned before we started, you are a woman of many talents, and business acquisition is not something that we have talked about that much on the podcast, but an incredible opportunity. So last time we talked heavily about real estate, short-term rental investing. What caused you to start looking at buying businesses?
Yeah. So, like you mentioned, my path, has really come through the different streams, should I say right now. But sometime I would say in 2020, so right when the pandemic hit, I stumbled upon an ad for a challenge, like all these like online challenges and things. And it was about buying businesses, how to ethically profit in crisis. And I saw this ad and I thought, that could be interesting because as you would expect, during the pandemic, a lot of small businesses were hit. And the person was basically teaching how you could come in and effectively buy a business that is in trouble, help the business owner get out of trouble, and take the business and basically run for yourself. And that was my introduction into the world of even just thinking about acquisitions. And I can tell you at the time, I remember he had us like change our Instagram profile to make it say, I'm an investor. And I did not see myself as a business buyer. It seemed like businesses were for like those people, whoever those people were, right? It seemed like it was for Wall Street. It was for rich folks. It was for just name all the things that at the time I didn't like identify as. But anyway, I humored the whole thing and I changed my profile, whatever. And I would say it took me about 2 or 3 years, maybe 2.5 years to actually internally embody the idea that this could even be for somebody like me. So now fast forward 2022, I attended another event. And during that event, I saw the numbers. And the same way the numbers for short-term rentals made me do a hard shift from long-term to short-term and did not look back, it was a similar thing for me with the businesses. Now, when I talk about the numbers, we can get into it, but basically, I saw that for the same down payment that you will be buying a short-term rental, the same 10% down, you could buy a business that cash flows 6-7 times more.
Yeah, it can be a really incredible cash flow play for sure from a business buying perspective. And there's still a lot of opportunity to generate wealth depending on the size of the business, what your exit plan looks like, what the equity multiple looks like. And we'll dive more into that. And for folks who are wondering about your background, I just want to mention that you are on the Physicians and Properties Podcast, episode 37. So that's a really great episode where we talked a lot about short-term rentals and your history and your journey. Hard to believe that was almost 2 years ago. Time is flying. Holy cow. Seems like it was just yesterday. But so for folks who want to know back, go to episode 37, Unlocking Short-Term Rental Wealth, after you listen to this episode. But yeah, that is exactly true. That, business buying is the shiny object that I have been thinking about a lot, or really for us in the assisted living side of things, it's like, okay, vertically, how can we integrate it within the mastermind to like solve someone else's problem or solve our mastermind members' problem or the industry as a whole. And so I think it's a really great way to do it, and certainly can be quite profitable. What did you see in business acquisitions that real estate couldn't offer besides the cash flow for you?
Two things. Number one, it's hard to ignore the cash flow. So there's no besides the cash flow because the cash flow is significant. I'm talking about, like, I guess in the RAL world, you see similar numbers, okay? But because with RAL there's a building involved, it's smaller numbers than you see with the businesses. But basically, for $1 million, you could buy a business that's cash flowing, say, $300,000 to $500,000. So that's huge. But the second piece is the ability to increase your value just by changing a couple of things. So the way a business is valued is based on the profit that it produces. So if you can get into the business and effectively change a few levers, so increase your sales, increase your revenue, or decrease your expenses, you can change your business value multiple fold just by those small tweaks. And the next thing will be what I call the arbitrage play, because businesses trade in what you call multiples. Okay. So for example, so businesses trade in multiples, and the more profit your business makes, the higher the multiple it sells for. So if you bought, let's just use a simple example here. Let's just say a landscaping company. You bought a landscaping company, it makes $300,000 a year in profit, not shabby. You probably buy that business for anywhere, like, let's say 2.5 to 3 times the profits. So now you're somewhere around that $750 to $1 million. Okay. Now you take that same business, you grow the profit to, let's just say, $600,000. Okay. Now at $600,000, it will trade at a higher multiple than the 2.5 to 3, because people will be more willing to pay more for a higher amount of profit. Now, where it really gets interesting is that you don't have to increase that profit by actually growing the business. You can increase that profit by buying another business of similar size. So you see that now people can basically go buy a bunch of small businesses at the 1 to 3 really multiple. And by the time they bundle a bunch of them together, they're able to sell to private equity companies at 8x, 10x, 12x, or whatever. And so that's the play that we are seeing in the medical space by private equity companies, because they are doing what you call roll-ups. They're buying up a bunch of small medical practices, buying them at 1x, because a lot of medical practices won't even qualify for the high multiples, and then they're basically rolling them all up together, and they're selling them for significantly high multiples. So that arbitrage play is the third thing I would say that caught my attention, and made me say, you know what, this could very well be the long-term play until something else interesting comes along. But this will be my long-term play.
You said it, not me.
Yeah. I'll say it first, okay?
Yeah. No, but it is, residential assisted living is a beautiful blend of real estate and business, right? So exactly. You do get that,
yeah.
That bug there. But you're right. There's potential for cash flow generation. There's potential for significant wealth generation. The roll-up strategy is amazing, right? Like, hey, how can I package these up, potentially sell it to private equity? And the private equity or some of these bigger buyers are looking at a business that's generating more profit, because that's also a business that probably has more systems in place, yes, and it's probably more optimized, and there's less key man risk, meaning there's more than one person who is doing that, or more than one like large shark that is the biggest client of that business. And so there's a lot of things to look at. But let's take a step back real quick. From a business buying perspective, what are your thoughts on buying an already existing business or starting one from scratch?
Yeah. So if you had asked me, let's just say a year ago, I'd have told you absolutely not. I am not doing a startup thing. Don't even bring that up to me. Like, buy. But in the last, I would say in the last few weeks, I've actually come to a more sort of tempered place in my mind that I can talk objectively about both. Okay. Now, Buying a business has the advantage of having less risk in that before you buy any business, you should be able to go back and look at the financials, at the track record from the last 3 years. So generally speaking, I look at the last 3 years of financials. I see what the revenue trends are, what the expense trend has been. I see what the profit has been, what like their, if they're paying their employees appropriately, if I'll have to raise salaries once I come in. You have history. You have, generally speaking, so I have 5 criteria of businesses that I look at. So the first will be revenue over $1 million, how many employees they have, preferably 10 or more, their profit margin. So usually I like to see at least on 25% of profit margin. What's number 4? The age of the business. So 10 years or older. And the 5th one is that it has a manager or operator in place. So when you have a business that you're looking at, you can actually scan it through these things and ask yourself, okay, is this business a solid business? And what that usually gives you is that it gives you history and potential stability that when you go in, you can cash flow from day one. So unlike a startup, like right now, I'm working on opening up a practice. And I can tell you, I don't have any clients yet. I don't have any patients yet. I don't have any employees yet. I'm still building out my offers to try to define exactly what I want to offer. I don't know what the market will respond to. Okay. But as I'm doing that, I'm also having conversations. I literally had one just this afternoon with existing practices that will look like mine. And I'm asking them the questions. Do you have injectors? Do you have these people? Do you have mid-levels? Do you have all these things? And I can ask the questions because they should already have their full operations in place before I take it on. So which is better? Okay. We always like to ask that question because, we are used to the randomized control trials and whatever, but it's context dependent. I would argue in favor of buying, but I will no longer poo-poo starting. But I will argue in favor of buying. If you can buy, you can cash flow from day one, basically. Yeah.
Yeah, I think buying right overall is probably easier than building. But I will say I have been thinking about this a little bit more in the context of a physician entrepreneur. Mm-hmm. I think depending on what that business you're building may be, yes. There's certainly a position and opportunity as a physician to build kind of as you go and build exactly what you want, which is what you're doing with your practice.
Exactly.
That then you can roll that experience into. That you may not get if you're like, hey, I'm a physician and I'm going to go buy a landscaping business, as you mentioned for your example. Yeah. There's nothing wrong with that by any means, but of course that's going to be run completely differently. So it all does boil down to, all right, what are your goals? Have you figured out what your vision looks like? How involved do you want to be? How much time do you have? How much capital do you have? And working it that way. Now, certainly buying an already operating business is going to be typically less time intensive than it's going to be to build your own. Maybe more capital intensive, but again, there's that trade-off. You're walking into a hopefully already cash flowing business, manager, operator ideally in place, opportunity to grow and scale, opportunity to roll up faster if that's something that you're looking at doing. So I think by and large, probably building is better. There's a great book called Buy Then Build, by Walker Deibel. Yep. That's great for folks to read to think about this. Main Street Millionaire by Cody Sanchez is fantastic. There's a lot of great small business books that have come out recently. Yeah. But that is really, really helpful, especially for things to look for in a business, because it is different fundamentally than real estate, and it's helpful to think about. What types of businesses do you like as a whole right now? I know you're focused more on the medical, which makes more sense, of course, but what types of businesses do you like most right now? And then why kind of the medical side of things?
Yeah. So my path has, I have liked different things at different points, and I'll tell you sort of what has swayed me one way or the other at different points. So when I first started my search, I was looking in the home services space. I was knee deep in real estate. We were rehabbing houses. We had 5 houses we had to renovate. And I figured, you know what? Buy your expense, right? If you're going to be paying, a contractor to fix your houses and he's marking things up to, $1 million, you might as well buy a construction company and hopefully bring down your rehab costs. And then in my head, I love the idea of buying a landscaping company. And part of it was because I wanted to landscape my house. Okay. And, because everybody else who wants to landscape their house thinks, you know what, just buy the landscaping company. Yeah. My husband was absolutely against that because he felt that like, no, this is all in your head and you're going to dump it on me. So we never bought the landscaping company. Let's just leave it at that. I looked into pool services companies, like pool installation companies. Again, anything home services, I was all up in. Plumbing, HVAC, I like those too, primarily because it's recession resistant in the fact that if your toilet backs up, you don't care how much you're quoted. You'd rather not sit in poop than pay money. Like, just pay the money and get it taken care of. So I've looked for, plumbing and HVAC companies, but guess what? I'm not the only one looking for them. Private equity companies are also all over them. And so their multiples have gone up significantly, particularly HVAC. Now, I looked at all of these niches and I actually got one of them under LOI. And that was actually very recently. But then for some reason, we had a huge tax thing happen and our financing fell through. And I was like, you know what? Somehow I heaved a sigh of relief when that happened, which made me kind of realize maybe there was something internally that I wasn't yet okay with. So I actually made peace with that deal not going through. But while all of this was happening, I was looking increasingly at medical practices, and regenerative medicine practices caught my eye. I realized that I like the med spas, but again, private equity was also all over them. And so they were always asking for huge multiples. I started seeing regenerative medicine and I'm like, what is this thing? It just seemed like I had this picture in my head, like, oh, this is just one of those non-medical medicine things, right? That's what I thought. And then I went for an event in June last year. And the way God will have this happen is that I was sandwiched between two doctors who were both doing regenerative medicine. They didn't know themselves. One was from Barbados and one of them was from South Carolina. And they just happened to sit next to me. So we got talking and they're talking about PRP and all these things. And I was like, what exactly is this thing? And they both explained to me, they showed me their patients before and afters. And I was like, wait, what? What is this? And so anyway, I then began just researching regenerative medicine. And I'm like, holy smokes, where did this come from? I didn't hear about this in medical school. I didn't hear about this all through residency. How has this been happening without my knowing? And so I started getting training. I began to kind of look at practices for sale in regenerative medicine. And I saw a couple that met a few of the criteria, but not all of them. The ones for sale tend to be on the newer side, and maybe with just one person doing the injections and things like that. So they didn't meet my criteria to acquire. But then after a while, I said, I can start this. I can learn this and I can do this. And they make a good amount of money. So, but they also help people, right? So that was how I went from let me buy, I'm not seeing what to buy, to let me start. And that's where we are right now. But now that I've started, I've learned a lot of the insider, the more medical part of things. I am now going back to looking for, actually searching for regenerative med practices for sale, because now I know the inner workings. Now I understand the lingo. Now I can talk with them and have an educated conversation with them. So I think previously I was of the opinion that just go buy anything, and make sure you have a manager in place that can help you kind of understand the workings of the business. But now that I'm working on this, I'm like, having some kind of insider information about the workings is probably not a bad idea. And so for a lot of doctors, based on where I am right now, I would still encourage folks to look in their own fields first, because having insider knowledge is definitely a plus. And if that wasn't, if that wasn't enough of a benefit, doctors can buy medical practices for zero out of pocket. 100% financing if you buy a practice that you could potentially work in. A number of banks would do it. You just call them and ask them if they have practice acquisition loans. And so if you are, tired of your regular job and you want to start a practice, you can look around and see if there are any retiring folks in your in your area. And when you do that, if you're actually going to work in the practice, then you may not even need to have all the other boxes checked off, because now you're going to work in it anyway. But now you won't be starting from zero trying to build that practice from scratch.
Yeah, that's a great key tip for folks, to kind of have a blend of building and buying at the same time. Can be really, really helpful. You mentioned your 5 criteria. One of them that probably stuck out was you don't want to buy a business that's less than $1 million. Can you talk more about that? Because folks probably heard that and were like, wait, that's crazy. Like, why don't I just go buy the frozen yogurt stand down the road that's $250K? I have my thoughts, but I'd love to hear what your thoughts are in regards to that.
So the reason that I have a minimum of $1 million, or the context where I have $1 million as my floor, is when I'm trying to buy what will be the so-called platform company. Okay, so basically think about your platform company as the core of what will be your acquisition empire, right? The
Yeah,
cell
like your
in the
hub.
middle.
Yeah, your foundation.
Your foundation. Yeah, that's the word. Talking about cells, of course. The foundation, right?
I like it. The nucleus.
Yeah, the nucleus. So when you want to buy, like, you want to buy something that can stand on its own, that can cash flow on its own. And when you buy in that $1 to $10 million of revenue range, you are higher than the mom and pop businesses. Those folks already have their systems in place. I mean, something got them to $1 million. Okay. So they probably have something that they're selling that is proven. They probably have somebody in the business that's helping them to sell and fulfill on their promises and make the sale. They probably have customers who know them, love them, trust them. They probably have like all the things, the vendors and suppliers that they've tested and tried over the last, however many years. Now, on the upper end of that, I have a soft, I call it a soft cap, because if I find, a good one above, then I'll have to go find partners. But at the $10 million mark on the upper end, you basically put yourself in a window where private equity is too small for private equity, but it's too big for those looking for jobs, those looking for mom and pop operations. Okay. So, but in that nice sandwich place, you can get it at a decent multiple that you're not overpaying. You cash flow pretty well. And because it's too small for private equity, you're not paying crazy high multiples. So why above $1 million? To make sure that the business is actually like tried, tested, has things in place already. And then on the upper end, I kind of stay less than 10 million in the meantime.
Yeah, I love that. The other thing to keep in mind for folks is that if you go less than that, there's often not enough profit in the business to pay an operator or manager if that's not already in place for you. So you're just buying a whole nother job. And so folks will fall into that trap often of like, oh, I want to buy this business for $200,000 because it's only $200,000 and I can get an SBA loan. So it's only going to cost me $20,000 potentially. But then they don't realize I'm buying a whole nother job and I don't have the margins or the profit to support putting an operator or manager in place. And so that's the reason behind it. And it's really important to take a look at that. And again, it all comes back to your goals. The other thing that's wild when you think about it is you're talking about buying $1 million business with an SBA loan for 10% down. So $100,000 are coming into this business that cost $1 million, which is probably generating at least $3 to $5 million of profit or gross revenue. Yeah. And so of gross. Yeah. And then, depending on what SDE looks like. So I guess before we go any further, do you mind explaining a little bit about the numbers and kind of like what seller's discretionary income looks like? What does EBITDA look like? Because fundamentally evaluating and doing due diligence on a business is a bit different. So how can a physician kind of avoid disaster? And then let's talk a little bit about how physicians could actually buy a business once they understand some of those fundamentals.
Yeah. So the way that I'll take this is basically just picturing a profit and loss statement in front of you right now. And if you're listening to this, feel free to pause this and then just go online and search for profit and loss statement. And if you just go on Google Images, something will come up and it'll probably look like this. At your top line, what we call top line revenue, that'll be how much sales came into the business top line. So They sold 10 widgets, they made $1 million, right? That's your top line sales, just what came in through the door. Right below that, you normally have what's called cost of goods sold. That means let's say they sold iPhones, okay? And if you're watching this, I'm holding my iPhone in my hand. But let's say they sold iPhones and they sold each iPhone for $500, but then each iPhone cost them $200. The cost of goods sold there will be $200. So they take that off the top line revenue, and now you have your gross profit. Now, I like to talk about the gross profit because very often brokers will mention gross profit as if it were profit. Gross profit is not your profit yet. Gross profit is just how much came off after you paid for the things that you sold. And it's still a pretty high number. Now, as we walk down, now your expenses come into play, your operational expenses. So this is where your payroll comes in, your insurance, your, how much you paid Johnny, how much you paid Alexandria, all the people that work in the business, you paid for your car, you paid for all the things, utilities, all those kind of come like one huge waterfall, and the money goes. And then somewhere at the bottom, they'll put in your depreciation. So so if you see depreciation on a profit and loss statement, that was not actually an expense. That was just an accounting number. So you normally add that back at the bottom, and then they'll take off their taxes and any kind of bill that they paid for their loans and things. Now, when you take off all of these, you have what you call your net income. Okay, the net income is where things start to matter. Okay. But from your net income, before you get to your net income, a bunch of people have been paid. But what matters to you as the buyer is what the owner took home from the business as his benefit. Now, if you're going to kind of talk about a smaller business, say a business that's doing about $1 million, that owner benefit is called the seller discretionary earnings. Okay. So your seller discretionary earnings is what the owner took home. But as you can imagine, if you own a business, you write off a ton of things, right? All those write-offs are all in that expense and waterfall. So your job, or should I say the broker's job, somebody's job, is to go back into that profit and loss statement and pull out all the things that were subtracted that actually were a benefit to the owner. So that will be things like your owner's salary, the owner's car, vehicle expense, the owner's life insurance, things that they don't really tell on the health of the business. They're more just like the owner's stuff that he put in there. A lot of things like meals. Okay. Sometimes, it will be travel, but it was travel down to Miami, but it was travel for the business. So all those things kind of come out, and then they add them back as add backs. Okay. So when you talk to brokers, people talk about add backs, and they'll normally list them out and add them back to the net income to then give you what is a better picture of the profitability of the business, called the seller's discretionary earnings. Now, if you are going to buy a business, you want to make sure that the add backs are true add backs, because very often, and I saw this on a clinic that I was trying to buy. They were trying to add back the salaries of the nurse practitioners, of the PAs. I was like, wait, if you add the salaries of your people back, then you're going to leave me with the clinic that has no one in it. So brokers sometimes will try to play games, and sometimes it's just a case of either their inexperience or who knows? I don't know. I try to believe that I'm best in people, but you've got to be really savvy in pinching through those ad backs and really identifying what's a true ad back and what is not. Other things I'll be added back will be, what's it called? The depreciation, and then any kind of interest charges on loans that you will not be carrying, so any interest charges on, say a personal loan that the owner took out, that'll be paid off by the time you buy the business, for example. So basically, anything that will not continue in the business after the ownership changes is fair game to be called an add back. Now, another place that people kind of come in is that, let's say they spent money to build out something, or, to run a campaign for the business. Sometimes they'll try to add it back and say, oh, well, that only happened one time. Yes, it happened one time, but it gave you all the revenue that you now claim is your revenue. So it gets to be a whole discussion about what's a true add back or not. But when you then get that SDE or seller discretionary earnings number, the question then becomes, what multiple do you apply to it to determine what the value of the business is that you would then be paying? Depending on who you talk to, some people will do a multiple and then add the cost of all the equipment in the business. And some people would say, oh, heck no, the equipment in the business is part of what runs the business. So, that's all part of what you're paying for, plus or minus, right? I mean, you basically, see what depending on the day, I would, I would do one or the other. Yesterday, I had a conversation with a broker, and I did the multiple plus the equipment, just because I'm just trying to see if I can buy this thing. It doesn't meet other criteria, but it will work for me for the current business. But in other settings, actually, you can have like a company, let's say, for example, a trucking company that's making, let's say, $500,000 in SDE or EBITDA, depending on how you split your numbers. And if you buy it at a 3x multiple, it can come with trucks, right? It can come with significant equipment in it that then gives, huge tax and benefits. So I'll just throw this in there. Businesses that have a lot of equipment and things, they're nice for tax purposes because all that equipment can be assigned a value that gives you a huge depreciation or bonus depreciation thing that you can run on the back end. So the last thing that I'll say on numbers is SDE versus EBITDA. EBITDA is EBITDA. So that is earnings before interest, taxes, depreciation, and amortization. EBITDA is kind of, it's like SDE, but usually used in bigger businesses. The main difference between EBITDA and SDE is that EBITDA basically factors in the salary of the operator. So SDE is usually used in owner operated businesses, like smaller businesses that the owner is in there. So the owner's benefits what you use. EBITDA is used in bigger businesses where you have like corporate management, and then you have the salaries of the operators in there. So sometimes, like if I'm even going to place a value on a business that's using SDE as a calculation, I will remove the cost of a manager. Like if I have to hire a new operator, I'll take that cost out of it before I determine what the actual SDE is. So anyway, those two terms you kind of see thrown around, different multiples thrown around as well for those two classes of things.
That was great. Yeah, you explained that so well, and I think it's really helpful. Folks, go back, rewind, and listen to that again if you need to, because it can get a little complicated with these different acronyms and percentages and all these other things. So it can be really helpful. I do want to foot stomp again what you just mentioned, though. It's always important to back out the cost of paying a manager or an operator out of your SDE and make sure that the business can support that, and make sure that the business not only can support that, but can also support your goals as well. That's why it can be more beneficial to buy a business that does cost more because it's generating higher revenue. It has a higher SDE. You can offset some of that to pay a manager or an operator, and then you still have enough SDE to live off of if, say you want to leave medicine and just buy businesses, full time. So I think that is really, really important. And I think it's also important to think through that you want to buy systems and predictability as well. And so that is a key part to look at too, is what are the systems? What do things look like in the business? And how can I go in and add value, which is where I think as a physician, we have a unique opportunity in the healthcare space of we have so many different touch points with healthcare related businesses that we can come in and add a lot of value. What are your thoughts in regards to that?
Yeah, so two things, actually probably more than two things, but the first thing that I would say is one of the things that we as physicians tend to do a lot is because we have been trained and wired to think of ourselves in our niches, in our specialty niches. But I like to remind folks that you went to medical school. And this thought came into my head yesterday. And so this is probably the first way that I'm sharing it out loud. And it is, your med school knew the value of what they were giving you, and that's why they charged you so much. We come out of med school and think that our medical degree is only worth the specialty that we have chosen. So I'll just remind you that you are skilled to back up and acquire something that is steps back in your differentiation pathway. Okay. So that's the first thing that I would say is that don't be afraid to venture back. Okay. And imagine yourself in medical school with all the things you learned in medical school, you are equipped to have an educated conversation with anybody in any of these specialties at a baseline. Okay, that's the first thing. The second thing is in business, generally speaking, people tend to want to buy things that they can eventually build verticals off of. The one thing that I would just like to point out is that we do have things like Stark laws and laws in place to keep people from only referring folks to their own businesses. So just keep that in mind, that whereas other businesses have that like full freedom to do that, there are rules in medicine that you have to just be aware of and cognizant of. That said, you still have the ability to go buy something, like buy a multidisciplinary, clinic, or buy something in your own specialty. And you like, nothing says that because you have this business, you can then go buy this other business. It's just the whole crosstalk thing that I like to caution people about. Well, you are very skilled.
Yeah, exactly. Yeah, that is a great point. I love that kind of stepping back to med school and thinking through. I mean, although, I'm not an anesthesiologist, for example, I do have a decent understanding on, what happens in the operating room and what an anesthesiologist does and those sorts of things. So I can have at least a decent conversation and understand that more so. So yeah, that is a really, really great point. I wanted to talk for a minute about financing. So you had mentioned SBA financing. So what does that typically look like? And then is seller financing an opportunity to buy business?
So when I gave a talk recently, I said that financing businesses is like a charcuterie board. Okay. The options are so many. Like if you thought that creative financing in real estate was awesome, try businesses. Okay. One of my mentors actually had a sheet with like 150 ways you could finance a business. And yes, it gets super overwhelming, but basically just imagine that anything is on the table. Anything is on the table as long as you have a motivated seller. So the first thing, of course, is SBA. And the reason SBA is my so-called number one is that the government is basically wanting you to buy a business. They will let you put down 10%. And in the right setting, you may find a situation where you're able to actually do 5%, even with the SBA. Now, and basically SBA doesn't make loans, they guarantee loans. So different banks have their own rules and their own things, as long as it fits into the overall SBA guidelines. So SBA, 10% down. But the one thing to also know is that SBA will require putting a lien on everything that you have, basically. Let's just put it that way. So if you have real estate, if you have other properties that have equity in them, they will put liens on those things. So for a lot of people that have other investments, SBA is not their number one choice, which then brings you on to the next thing, which is that, okay, then what? I mentioned the physician practice acquisition loans for 0% down. Those are not SBA. Those are, bank specific. The next will be seller financing. That's just there. Now, even the SBA, actually, if you do an SBA loan, they will actually almost all the time require the seller to carry back like 10%, because it shows good faith in the business that they're leaving behind. But one of the things is that they would require that portion be held as a standby note. So you don't make any payments on that until you've paid back the SBA completely. Yes, go ahead. She's asking me for gum in the middle of my, she's come twice now.
It's okay. It's okay. Family is welcome on these podcasts. I get interrupted all the time.
And then, so SBA, the doctor financing, and then seller financing. So seller financing is beautiful because basically you're having the seller let you pay them for the business over a period of time. It's as flexible as humans are different. You can have a seller say, pay me in 2 years, pay me in 3 years. You can have a seller say, pay me in 20 years. Okay. But the key is creating a win-win, or creating a situation that is a win for the seller. And this can be basically packaged in different ways. For some people, you say, okay, what do you like? I know you want to sell this business, but do you have any plans for the cash when you get it. And for some, they're like, well, not really. I just want to, take time off or whatever. And you say, okay, well, would you be open to, me paying you overtime? And it's basically like a paycheck almost. And some people will actually be open to that because it reduces their tax liability and lets them get a paycheck over a period of time. And some will say, oh, absolutely not. I want all the money right now. In which case, sure, on to the next thing. Other things that people can do that can be earnouts. So earnouts are basically, where you buy the business and you basically tell the seller, if you stay along and kind of help through a transition period and the business does XYZ, then I will pay you this extra over a period of time. There are so many things like management buy-in, where you come into the business and manage the business, and that becomes your way of getting equity in the business. Some people call it consulting for equity. Of course, you can work with investors in the form of debt or equity. There is leverage buyouts. So basically where you use the assets of the business to finance the acquisition of the business. So say, for example, the transfer company I mentioned earlier, they have all this equipment or all these trucks and things, and they're all free and clear. You'll be buying them. You can go to a lender and they'll give you a loan on the equipment. And now you can mix that with some seller financing, give the seller a nice payout on the day of closing, and then finance the rest of it. So many things. I even just sitting here, I'm like, okay, so what else? But there are a few that are used a lot, but the more even things like the accounts receivable. So a business says, you do $1 million a year, but our accounts receivable is like, $200,000. Say, okay, you take the accounts receivable. There are companies that will finance the accounts receivable for you and basically let you pay them back as you collect that money. So because there are so many touch points of money in a business, there are also so many ways to finance things, to finance an acquisition with low or no money down. As I say that, I also kind of let people I tell people that, just go into it with the mind of, I'll put down 10%. And then when you get there, if you then find ways not to put down 10%, then fantastic, Fantastic.
Yeah, that's cherry on top. Yeah, I think bottom line, there's a lot of flexibility in financing financing businesses more so than just relying on a bank. And that's really important and, really, really cool to see. And I think seller financing is such a huge opportunity as, of course, the silver tsunami has been talked about a lot in this podcast for residential assisted living and more residents, but there's a huge opportunity in the small business acquisition space as these baby boomers who own a lot of these mom and pop businesses are now looking to transition and retire. And that offers an incredible opportunity to come in from a seller financing perspective and be like, hey, I understand that you're selling this business, you're mom and pop, you want to retire. How, as you mentioned, how does it feel if I pay you $3,000 a month or whatever that may be for the business instead of just buying this outright or having to rely on a bank to finance it? So it can really help you have a lot of structure and flexibility in your financing. And as you mentioned, you can sometimes get into this with no money down potentially. So really, really cool opportunity.
Yeah. I like to always add at this juncture that very often when I give these talks, people get super excited. And then I have to add, but you've got to do due diligence.
A lot.
The due diligence is more significant than with, say, buying a short-term rental. Short-term rental, your due diligence is like 14 days. You go in there, you walk the place, you look at you look under things, you check the water heater, you check all those things, and you're done. With businesses, there are different layers of due diligence. There's financial due diligence, where you have an accountant, a paid accountant, and you pay them pretty well. Accountant basically go through the financials of the business, basically ask all the questions. The first time I did due diligence, I was like, holy smokes, they had a whole sheet of questions had they asked. And then there's legal due diligence, because the one thing you don't want to do is to go buy a business that has, lawsuits hidden in the cracks, right? So you have an attorney basically go in and dig through all the court records and things just to make sure that there's no outstanding or pending judgments or liens on the business or, people in the, lying in the woodworks. And then there's also just I forget what it's even called, but it's basically let's due diligence on the feasibility of the business itself. Like, for example, I saw a company for sale probably like a year ago or so, and it was an AI company. This was a year ago. Okay, so that company was probably about maybe 2 years old, and they had made bajillion million dollars, and they were trying to sell. But then the key thing there was whatever they were doing will probably be obsolete in the next, 3-4 months, the way AI is moving so rapidly. So we did not go forward with that one. So even just asking, are there any city, state, legislative, things that could upend your business? Any tariffs coming up or being threatened? How did it do in COVID? How has it fared with all the changes around the world? So your due diligence period, we usually put in like a 90-day due diligence period into our LOIs or letters of intent, and then of course a funding contingency as well, just to make sure that you are covered. And the due diligence piece also is another reason that you want to buy a bigger business, because at least the bigger business will make the $20K you spend on due diligence worth your while.
Yeah, those are all really, really great points. And it can be costly to do due diligence and underwrite a business and do it right and do it well. But it's incredibly important because there's so many different things under the hood of a business and so many like more potential skeletons in the closet than there is in real estate. And you want to make sure that you're evaluating that. And that is awesome. I love that. In the last few minutes of our time, I'd like to pivot briefly into if I'm a physician listening to this right now and I want to get started evaluating a business or trying to find a business, are there any good resources or places to look for potential business buying opportunities?
Yeah, so potential business buying opportunities, I would say go scout BizBuySell. BizBuySell is the place that anytime I'm giving either talks or talking, that I just show people. I'm like, type your city in and just pick your cash flow number. And I've done this live a couple of times, and we always find something for someone. But yeah, BizBuySell, basically, when I'm in search mode, I just scout there, either every day or at least once a week to see if something new has come up. And then get in touch with an SBA lender in your area to kind of get that conversation going, so that if you see something that you'll be able to, to jump on it. Usually on BizBuySell or any of the other online platforms, they will ask you to fill out a little form. You fill it out. And when you start to get information, they'll ask you for an NDA. You sign the NDA. They send you what's called a SIM, confidential information memorandum. And then you review that. You go through the numbers. If it's something you want to go ahead with, you then hop on a call with the seller, ask them all the questions. If it's something that you want to go even forward with, then you make an offer. The offer is in the form of a letter of intent. There'll be some, back and forth in the negotiations, and then they sign. When they sign, now you're under contract. You're in due diligence. You get your due diligence team together, and basically start the back and forth to determine if you want to go forward or not with it.
That is great. Yeah. And I think for folks just looking at BizBuySell for the first time, it can be really overwhelming, but also helpful to look at BizBuySell and see and kind of figure out, okay, what is my buy box for a business? Start underwriting some of those businesses, look at the SDE, kind of, work those numbers back and see, hey, does that make sense? And look at their numbers and just start running more and more calculations and going through the motions more. And that's going to help you get knowledge in the space, but also help you to see what stands out, let you know, hey, this may be a good opportunity worth pursuing. Talking to business brokers is another great way to do it too. I would say, make sure you know what you're doing before hopping on a call with a business broker, trying to build a relationship with a business broker, because they get so many tire kickers. And so if you want them to take you seriously, if you want them to potentially bring you, these valuable deals, then you need to make sure you know what you're doing. So at least figure out your buy box, your goals, what that's going to look like, and understand the basics of business buying before doing that. But that's also a great resource.
Yeah. Now we've also put together, we have the whole inner circle and things for those who want to, learn how to do this. Because one of the things that I've found in this space is there's more to businesses than meet the eye on the surface, and experience with actually just going through these things is really key. So when I started doing this, I had a phone call with a mentor of mine. I had a business under LOI under contract, under letter of intent. And I was actually going to go ahead. But then during the due diligence, the accountant and the legal guy and the attorney, they found something on the P&L, and they basically noticed that the seller wasn't categorizing the employees the correct way. And I thought, I mean, it's landscapers, because it was a landscaping company. I was like, they're all going to put them as 1099s. That can't be a big of a deal. So I was still going to go ahead. But everybody was like, everybody that I kind of hinted at that was like, oh no, like you need to have that, done well. So I reached out to a mentor. I was on the phone for something else. And I was like, oh, by the way, I have this little issue. And he goes, oh, on to the next one. And I was like, wait, what? And he was like, yeah, on to the next one. And basically, to recategorize the employees from 1099 to W-2 would have cost me about $350,000, which would have wiped out our cash flow completely. So it took me having somebody like that to just ask that one thing. And so when I was going to bring this into our physician space, I'm like, at this time, I'm not the one to teach you. I'm not the one to like find those things for you yet. But I pulled my mentor along and I was like, hey, would you like to be the person to, and he agreed. So now we have all that, on the back end that people can reach out to me if they want to learn about.
Yeah, absolutely. And that's huge. And that really shows the value of mentorship and community, and being willing to kind of put yourself out there saved you $350,000+ and kept you out of a deal that would have been a huge headache for you. And so it is really important to think about that. One last question before we wrap things up. If you were a physician and you were you are a physician, but if you're a physician listening to this and you're going to buy a business today, what would you buy and why?
Well, considering that I'm looking right now, I'm looking for regenerative medicine practices because that's where my interest lies. So the first thing will be something that I have some interest in, something that I have some knowledge in. And people will argue about this one, but not where I am right now, that I will put those two together. I would look, if I were a physician, I will look in the medical space first. And then I would look for good old run-of-the-mill boring. For example, we've looked at, actually, you made an offer on an equipment rental company. Why equipment rental? You don't need to have any special skills to do equipment rental. Like, I've got chairs. You want to rent chairs? Here is my chair. Take it. Like that kind of thing where there's no serious like specialized knowledge needed. And, things that outside of medicine, I'll go for things that don't require a significant amount of like technical knowledge, like deep skilled knowledge, because in the world right now, overall, people are short staffed. So if I can find something where the training process is not terrible, long or arduous or whatever, and I can find people to fill in, that will probably be my go-to. I still like my home services. I will still buy a plumbing or HVAC company right now, even though I can't change a toilet, because I know that there are people who can do that and I can find them easily. So medical for me, plumbing, HVAC, equipment rental, those would be my top. People will ask me about car washes. They'll ask me about what's the other one?
Laundromats, probably.
Laundromats, yes.
Yeah.
And for me, I personally would say probably not. And the reason is, this is my reason, the ones that I find are usually below my revenue number. And
yes.
For laundromats is the logistics of coins.
Yeah. You got to get rid of the coins, and really expensive to repair or replace. Same with a car wash if it breaks. So I agree on that as well. I love all of that. It fundamentally, what you mentioned was service-based businesses.
Service-based.
That's what you're looking for.
Service-based, yes.
Yeah, which is great. That is awesome. I guess one last question. If someone's listening to this right now, they feel intrigued, but they're overwhelmed maybe, where would you say to start this week?
Go on BizBuySell.
Okay. Love it.
BizBuySell. Yeah. Just go take a look. Yeah. And I mean, I have videos on my YouTube channel or whatever that people can go, like I have a few of our full trainings on our YouTube channel. And that's
awesome.
At Dr. Fawole on YouTube. Just scroll down. Scroll down.
Sounds good. Yeah, I would say BizBuySell. But first, if you have not, take that time to figure out what does your vision look like? What are your goals? What are you potentially building or buying a business for? Is going to be really, really important. Well, that is awesome. Well, if folks want to reach out to you, they want to know more, they want to learn more about what you're doing, how could they do that?
Easiest place will be find me on Facebook, Chiagozie Fawole. I'm probably the only one. I have 2 profiles on Facebook. There's a pink one and a regular one. Just pick one of them, preferably the one that is not the pink one, to actually reach me in my DMs. But I get stuff all the time. But yes, that's the best place to reach me on.
Sounds good. Well, this has been fantastic. I think folks definitely got a lot of value from this episode. I think business buying is a really fantastic opportunity. And so folks, if you did learn something from this podcast, go ahead and give us a 5-star rating and review. And with that, we'll go ahead and wrap things up with this episode of the Physicians and Properties podcast.
Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only. It should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.